Hello, my name is Cheryl Dunn, and I'm here to demonstrate the PDQ Industries problem for you. In this problem, we are given the information that PDQ Industries is a brand new company that started on June 1st, and then they've been in business for a month, and so they've been operating, and we're given the accounts they have, balances in at the end of June, and we're asked to create the financial statements for the month of June. And so we're asked to make an income statement, a statement of retained earnings, and a balance sheet. So I'm going to start by kind of dividing up my board here so that I don't write too big and run out of room. So I'm going to make my income statement right here. And I'm going to make my statement of retained earnings down here. And I'll make my balance sheet over here because I happen to have looked at the accounts and realized that my balance sheet's got a lot more accounts on it than my other two statements do for this company. So I'm going to start by writing the name of the income statement up here. First the company name, PDQ Industries. And what we're making for PDQ Industries is an income statement. And I have to define the time period covered by the income statement because an income statement is a statement that covers a period of time. It has a defined beginning and a defined ending. And so I need to specify the fact that this is for the month ended June 30th. Okay? Then I think about the structure of an income statement. We're just going to use a simple income statement for right now. And so basically we're going to have our revenues minus our expenses, and that's going to give us net income. And so now we just have to fill in the details for this particular company. If we look through the list of accounts that you're given, and we look for which ones are revenue accounts, you'll see that we have an account called service revenue. Since there's only one revenue, we really don't need to write both the subheading and the account name, but it's not wrong to do it this way. If we had more than one revenue, we would list them each separately and then we would get a total for the revenues. Our service revenue in this example is $5,550. So we write that in there. And then our expenses. We do have two expense accounts. We have utilities expense and we have wages expense. The utilities expense in this case is $1,200 and the wages are $2,100, giving us a total expenses of $3,300. If we then take the revenues of $5,500 and subtract the expenses of $3,300, we end up with $2,250 as our net income. And that's our income statement. The financial statement we make second is the statement of retained earnings. We had to do the income statement first because we need this net income number in order to calculate retained earnings. We'll start our statement of retained earnings by again repeating the company name at the top. And then we'll put statement of retained earnings. And this, like the income statement, is a statement that covers a time period. It has a defined beginning point and a defined ending point. And so we are going to again write for the month ended June 30th. Okay, the structure of a statement of retained earnings is we start with the beginning retained earnings. Now because this is a brand new company on June 1st, the beginning balance in retained earnings was $0. They hadn't earned anything yet. You'll notice that account was not given to us on the list of accounts, and that's because often when we're given a list of accounts, If the account has a zero balance, it just simply doesn't appear on the list. But we do know that the beginning balance would have been a zero, and so we put that on here. This statement then says add net income. So beginning retained earnings plus net income, then minus dividends, equals ending retained earnings. That's the structure of the statement of retained earnings. So basically that's an equation that you want to memorize. You want to be able to use it backwards, forwards, and upside down. Same way as with our income statement, we use the equation revenues minus expenses equals net income. Again, know it backwards, forwards, and upside down. You'll need to use it many times. Okay, in this case, the net income we calculated in our income statement here, $22.50, and so we write that in as our amount to be added to the beginning balance of zero. And then the dividends were given to us as $400. Pretty unusual company to pay dividends in the first month of operations, but it gives us an example to use. So then we take the $22.50, we then subtract the $400, and oftentimes on financial statements when you see something subtracted, we could have done that up here with the expenses as well, you'll see it listed in parentheses. And then when we make the subtraction, we end up with ending retained earnings of $1,850. Okay, so finally we'll make the balance sheet for PDQ Industries. Again, we start with the company name at the top, and then we write the words balance sheet. And now this statement is not one that covers a time period. It does not have a defined beginning point. Instead, it's a snapshot at a point in time. So the date that goes on our balance sheet is simply June 30th. We then put our structure of our balance sheet in place, and so we know that the equation that is underneath our balance sheet is what we call the ALLO equation, or assets equals liabilities plus owner's equity. And so we're going to start by putting our assets section here on the left, and on the right we'll put our liabilities and our owner's equity. And then we will reach a point at the bottom where we'll have the total of the liabilities and owner's equity, and we'll have the total of the assets. And the two numbers better equal, or we'll know we did something wrong, because a balance sheet has to stay in balance. It's like a scale. And so we've got one of those scales where you have the two trays that go up and down. When one side is weighted, it will go down. The other side will go up a little bit. To even it back out, we have to either take something off of this side, or we have to add something to the other side so that they'll come back in balance. The balance sheet is like that. One side has to equal the other. So if we look at our list of accounts, the first asset that we're going to put in place is cash. Assets on a balance sheet are typically listed in liquidity order. So whatever's the most liquid, meaning the closest to cash, is going to come first, and then they go gradually towards the longer term assets that aren't anywhere near cash. And so we're going to start with cash itself. That's the most liquid asset of all. And our cash for this company is $5,700. Accounts receivable is usually the next closest to cash, because all we have to do is collect it from our customers. So we're going to put in our accounts receivable, and the balance of accounts receivable that we were given in our list is $1,500. Okay. Then we're going to put in, let's see, what other assets do we have? It looks like everything else is probably long-term assets. And so we'll put the order, we usually put land before we put other long-term assets, because land is one that doesn't depreciate. Typically when you sell land, after you've bought it. If you've held it for a while, it's not always the case, but in general, land tends to appreciate. And so we say that the salvage value of land is higher than the price we paid for it, and therefore there's no depreciable cost. There's no cost to allocate over that land's life the way there is with other fixed assets. And so we're just going to write in the land, and the cost value of that was $6,750. Then we'll put in the buildings. And the cost value of our buildings was $3,750. Then we'll put in our service tools. I'll just call them tools. And the value we were given for that is $1,550. And then our service vehicles, which I will simply label as vehicles, that is $2,950. Okay, so these are all examples of assets for the company. Let's make sure we've got all our other accounts accounted for, and then we'll go back and add those up. So accounts payable, if we start at the top, that is a liability account, and so we'll put that over here. So accounts payable, and the balance of that was $1,950. Okay, accounts receivable we've accounted for, buildings we've got, cash we have, common stock. Okay, common stock is an owner's equity account, so we'll put that here. And that value was $18,400. Okay, and then we have dividends was on our statement of retained earnings. Land is here in our assets. Service revenue was on our income statement. Service tools is here on our balance sheet. Service vehicles is here on our balance sheet. Utilities expense and wages expense were on our income statement. So we've accounted for all of our accounts, so now we just have to see if our balance sheet balances. And so if we add up our assets here, we're going to write total assets. And if we add those up, got a 0, 5, 10, 15, 20, 9, 14, 21, 28, 33, 42, 9, 10, 16, 19, 20, 22. So we've got $22,200 is our total assets. Oh, what did I forget? Oh, retained earnings. I forgot retained earnings, didn't I? So common stock is our contributed capital. We also have to add in what we earned from within. We call that earned capital. And so the retained earnings that I calculated over here, I have to turn around and pull this over to here because that increases my owner's equity. Okay, so now if I add up all three of these numbers, the 1950, the 18,400, and the 1850, I think I'm going to be close to having my 22,200, hopefully. So 0, 0, 0, 5, 10, 10, 14, 22, looking good so far, 3, 11, 12, and indeed we do end up with the $22,200, our balance sheet balances, and of course this label we would have given as total liabilities plus owner's equity. Alright, so you can see here we have a complete set of financial statements minus the statement of cash flows. We were not asked to do that, so we aren't doing that. For this problem we didn't have enough information that we could. So we have our income statement, our statement of retained earnings, and our balance sheet for PDQ Industries. I hope you found this helpful.